Welcome back to Investment News TV. My name is Andy Burt, and I have the privilege of being joined by Chris Loveless of O'Shaughnessy Asset Management, which is a part of the Franklin Templeton family.
Yes.
Welcome to Investment News TV.
Thanks, it's good to be here.
So in these times of uncertainty, how do your clients come to you, and how do you reassure them about the direction that you're going?
Well, so I think the reason clients are coming to us is because they are wanting to move from portfolios that are invested without tax management or the ability to personalize. So the way that we say it is you can bend the portfolio for taxes, you can bend it for values, you can bend it for concentrated stock positions, which could also be concentrated mutual fund, like really low basis mutual funds, and bend the portfolio for transition, meaning that the advisor has won a new relationship, it's invested in this, the advisor sat down with the client, learn their hopes and goals and dreams and what scares them, and says, you know what, I think we did a different allocation based on what you're telling me. And they have to transition it. And so we can help the advisor manage that process, take all the complexity of that off their table. So, they're coming to us to solve those problems. And really, it doesn't matter what the environment is. I think we're still going to have good growth, even if we were to go into a market that was down 20% over an 18-month period, I think we'll still grow.
One of the things that I noticed just reading through your website and your sort of philosophical approach is you've got a very distinctive sort of a step-by-step investment process.
Yes.
I was wondering if you could just kind of walk us through that a little bit.
Yeah, so we are quants at heart. We regard ourselves as factor experts, meaning that we understand the earnings of the PE. We understand the P at a very granular level. In fact, one of the things that's unique about us, if I were to show you a pitch book and I were to go around this hall and gather everybody's pitch book, I would bet money that we're the only manager in here who we don't pull that data, that characteristic, the math behind it from FactSet or Bloomberg. We're actually calculating that because we understand that factor so well. So we are factor experts. And so we have very quantitative process. It starts with what's our universe of stocks that we're going to pull from. We generally have, we get rid of stocks that score the worst across value, momentum, yield, and quality. And then based on whatever the strategy is, we'll lean toward growth or value or yield, depending on, because we do have lots of different strategies. So that's what we do on the active front. On the passive front, we're just replicating, passive indices, which is also a quant strategy, really, because most, like the S&P 500 is just the 500 largest companies. It's sorted based on size, effectively. So you could argue it's a quant strategy. So that's our philosophy, and it's served us well.
Yeah. And so you have direct and custom indices that you do. And so what is your general approach for each of those?
We are trying to mimic the underlying strategy, whether it's the S&P 500, the Russell 1000, it could be a Putnam large cap value. So Franklin also bought Putnam within the last few years, so they're part of the family now. So we can do it on their strategy as well. So what we do is we try to manage using tracking error as our guide. Try to manage to no more than 1% tracking error to replicate that strategy. But it gives us a little wiggle room so that we can deviate, so that we can sell stocks that are at a loss in the strategy and then come back to them.
Excellent.
That tracking error is the key guidepost.
Yeah, and how, when you work with advisors, what is the benefit of kind of taking this approach?
So the real benefit is that they are able to deliver their clients not only the returns of the strategy, but do it in a tax efficient way. So maybe said another way, if you were invested in a direct index that was the S&P 500, and I was in the SPY, the S&P 500 ETF, you're going to always have more after-tax money than I do because there's something going on in your account because you own the individual names. There's some harvesting going on anytime that chance is provided that I don't get as an ETF holder. So advisors then can serve those tax losses to their clients for them to use either to get out of a low basis position, to offset the gain that comes from when they sell their business, sell their house, something like that. So, for advisors really haven't been able to deliver value added from a tax perspective, and now they can't.
Chris, it's been a great chance to talk to you. Thank you for
Yeah,
joining us.
absolutely.
My name is Andy Bird, and this is Investment News TV. Thank you.
Yeah, you bet.